Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and joined by my co-host,
Andrew. Here we are, Bills, back again on for another exciting and riveting podcast. How you been, mate?
I have been well, Andrew. Thank you. Just trying to survive the cold weather that is Melbourne, but that's the joys of living in the most livable city. I don't know if we're on top of the list. I think we've slipped down a little bit, but we'll just ignore that fact for a sec.
What was the most livable city?
I don't know what still is. It's just that whoever's putting the list together just doesn't realise that they've skipped over Melbourne, I think, for the last 2 years. Is that right?
Yeah, in at least a couple of years, but we'll blame it on the weather. That's why. It's what we can't control.
Exactly. But no, all going well and looking forward to today's podcast, Andrew. This is something that I'm really excited about, really passionate about. It'll make a little bit more sense once we get into it because I love working with business owners on their financial planning and their growth strategies and so on and so forth. So this one really resonates with me. So really excited with this topic today, and I reckon it will give our listeners a whole heap of value because it's not necessarily something that you would have heard about or been exposed to unless I imagine that you've received advice on this. So I think this is a bit of a sleeper. So yeah, pretty excited about it. Andrew, tell our listeners, what are we talking about today?
Yeah, so today we're talking all about buy-sell agreements is essentially what it's called. Basically what this is, it's an agreement that determines how an owner's share in a business is going to be divided on their eventual death or if they're permanently disabled. It states that if an owner passes away or disabled, a lot of the times the way that most buy-sell agreements are structured is that the surviving owner of the business is obliged to purchase their shares in that or their interest in the business is essentially what it is. Bit of a long-winded and massive mouthful there, so we'll dissect that a little bit and break it into some smaller pieces. But essentially, it's what we're talking about today is all about buy-sell agreements.
Okay. I might use an example, Andrew, because I reckon that that's probably the easiest way. So you and I are in business together. Touch wood, if something happened to either of us, our spouse would be obviously the beneficiary of...
Yeah, this is if there's no buy-sell agreement. So without anything in there, yes, that's...
So in the normal course of how things progress, I'm out of the picture. My wife obviously inherits. She's got my assets anyway, so there you go. Hi, Sam, how you going? But essentially, she owns my portion of our business and is now essentially in business with Andrew. So is that something that she wants? Is that something that Andrew wants? Is that something that I want? Probably not in all reality, because it's going to be devastating for Andrew if I'm no longer around anyway. But the last thing that he's going to want is to have another partner in the business who's not involved in the business, doesn't understand the business. It just makes it difficult for so many people. And in Samantha's perspective, she realistically would just want the value of our ownership in the business so she can then get on with her life and find another husband and stuff like that. So
yeah, live lavishly with the next...
So a buy-sell agreement is designed really to do two things. First part is the contractual arrangement between the parties. So in the event that predefined event occurs, usually death and permanent disability. So in the event that occurs, the shareholding the deceased or the disabled business partner owns goes to another party. In this instance, it would be Andrew. And then there's an insurance policy that is the funding mechanism to pay out my shares. So if we rewind a little bit, if we didn't have this agreement and Andrew needed to pay out Samantha, my wife, he'd need to come up with the money to buy her out, which may cause issues for Andrew, that he may not be able to do it. It may cause undue stress on the business, on his own personal circumstances. So the way that we mitigate that is by having an insurance policy to be able to pay out essentially the departed business owner's share of the business.
Yeah, exactly. So if this agreement wasn't in place and you hadn't done any of this, usually there's two scenarios and two things that will happen. And that's number one, there's a party involved in the business that's a decision maker in essence because of their shareholding, because of their ownership amount in the business that may or may not want to be there and may or may not have the experience, knowledge to be able to continue running that business. So that's not desirable really for either parties. Or in the instance whereby the surviving business partner, so in that example myself, can't actually afford to buy out that interest in a moment's notice, and the eventual outcome is the entire business needs to be liquidated or another party needs to come into into the business in order to be able to facilitate that buyout, which you think about most of the time when people are getting into business. Yes, you're getting into it for obvious financial reasons, but the other thing that you're also doing is you're wanting to build a legacy and you're wanting to build something more. And not that you're going to be around to see it anyway, but to know that what you've built and what you've spent the last X amount of years doing has resulted in that just eventually depleting into nothing is not the outcome that most business owners would like to have. And so hence a buy-sell agreement in order to be able to make sure that everyone is taken care of, whether it's the business owner, whether it's the surviving spouse or beneficiary of that asset. It makes sure that absolutely everyone is taken care of and everyone has not the, or doesn't need to worry about the financial aspect of things and can deal with the emotional impact and all of the other things that are no doubt going to come to fruition if one of those unlikely events happen.
Well said, Andrew. There's a few moving parts to it and it's highly complicated. It's very easy to get this wrong as well too. So usually when these things are put in place, in my experience, it's usually a financial planner who's driving this conversation with their clients. We'll raise that consideration with business owners, and the more business owners there are, the greater the complexity. I think that's fair to say. But generally speaking, you'd need a solicitor involved to draft up the contract. That's relatively straightforward within itself. What tends to get a little bit more difficult when it comes to this is determining a valuation on the business, or not even a valuation per se, because the valuation today versus the valuation down the track will change depending on the growth of the business and so on and so forth. But coming up with an agreed upon valuation methodology that everybody's comfortable with to say, hey, in the event that this happens, this is the methodology that we've agreed to in order to value the business. So then in the example that we used before, the spouse is not being disadvantaged because we picked an old valuation when we got this done 5 or 10 years ago, and that's no longer relevant for today's valuation. So that's probably the first thing. There may be an accountant or a valuer involved in that process as well, in terms of putting the value of the business together or determining the valuation methodology framework. And then you've also got either a financial planner or an insurance broker that will put the insurance policy in place. So you need all of those things sort of working at the same time. But there is a high degree of complexity associated with it around things like ownership structure and different amounts and bits and pieces, which we'll go into now. But yeah, usually there's a handful of professionals involved in setting one of these things up.
Yeah, and look, this is something that we're always talking about, receiving good quality advice, but I'd make sure that there's a real huge caution to receive advice in this, because scribbling it on the back of a napkin and taking out insurance policies really isn't sufficient in the event that something like this happens, because a lot of the times you A, talking about a large sum of money, but B, not receiving the right advice from the solicitor, from the advisor, from the accountant can mean that there are tax consequences along the way. And so you want to make sure that you're mitigating that as much as possible, and you're making sure that no one is disadvantaged at the end of the day and no one is left without. So structuring this in the right way is ultimately very important when you're embarking on something like this. And so making sure that you've got the right professionals in the room is really imperative.
Yeah. The other thing with business as well too, Andrew, the ownership structures can change. Well, not change, but get more and more complicated. You've got sole ownership, you've got companies, you've got trust. Understanding the ownership structure and making sure that it's being funded through the right entity as well too is critically important, because it can have some adverse consequences down the track, especially from a taxation perspective as well too. So making sure that the structure is understood, making sure that you understand who is the owner of the shares or the business, and making sure that when that policy is funded, who is funding it and who is the beneficiary of the proceeds of that policy as well. So high degree of complexity. Probably the other thing that we need to point out as well too is determining what constitutes a trigger event. So fairly straightforward with death. You're no longer around. That makes perfect sense. In the event that you're permanently disabled, that could be another consideration as well too.
Yeah, exactly. So really most business owners will really consider both of those things. You'd consider a policy upon death. That's the simplest. That's the most obvious. If someone's no longer around, as you touched on, the other scenario is they could still be around, and feel like the Grim Reaper every time I talk about these types of things, but it's unfortunately the reality sometimes. But there's also the instance of permanent disability. If someone is likely to never return to work again, then whether they still continue to hold shares in the business, whether they still want to hold shares in the business is another question. And so a lot of the times business owners will have a buy-sell agreement for permanent disability as well, in order to make sure that the family unit can be paid out their interest in the business without having to go through the complicated process of actually selling and liquidating the business. This is something that will be triggered automatically and that you don't need to have to put mental time and attention in an environment where there's a huge amount of stress that's involved.
No, well said, Andrew. I think what we might do, because there's one other thing that I want to point out that we always sort of experience when we're putting these things together in terms of a challenge that we face. So I might use an example because I reckon that might be the best way to describe it. Let's just assume you and I are in business together. We're equal partners and we own a business that's valued at $1 million. We'll just use some round numbers and we're equal partnership. So our share is worth $500,000. So we go through this exercise and we determine the trigger events are going to be death and total and permanent disability. That's pretty straightforward. We determine that we're going to use a particular valuation methodology, which is what we use to determine $1 million value. In today's dollars, we turn around and say, okay, we value the business at $1 million. So we take out a life and total and permanent disability policy for $500,000 each. In 6 months' time or a year's time, the business is worth more. So do we run the risk of insuring for $500,000 today, knowing that tomorrow that the insurance policy is going to be short? Or do we try and compensate for future years of growth so we don't need to go through this kind of insurance adjustment every 6 months or a year? And I guess it really depends on how quickly the business is growing. And it also depends on the appetite of the business owners as well too. But specifically for life and total and permanent disability insurance, relatively speaking, it's quite affordable. So it would make sense. And the underwriting process at times can be quite onerous, but it makes sense to insure yourself for more to compensate for future years' growth. And then once you reach that valuation, you then revisit the policy and increase the cover that you've got.
Yeah, exactly right. For us, that's usually the preferred solution is you overinsure, you make sure that there's some wiggle room and some buffer in there because of the fact that you'd hope that the business is continuing to increase in terms of value. And so as a result, the amount of insurance cover or the insurance need is going to increase. So you want to account for that and you want to make sure that you're accounting for some future growth within that. And what you've also touched on there is the importance of reviewing this policy and this structure as well. So it can be really easy to just forget about it, set it up, you know that that's taken place, goes to the back of your mind, you don't think about it because no one wants to face their own mortality. However, reviewing the amount of insurance cover is one of the many things that you need to look at. But the other thing that you also need to consider is how have people's family dynamics changed? Is the policy ownership structure still the right ownership structure as what it was back then? Are there now more partners in the business that also need to be accounted for each and every time you're bringing other people into the business? Is the valuation methodology still the same as what it was when you took out this agreement? Because you might use the valuation methodology now, but that may not be relevant in 5 or 10 years' time. And so making sure that you're constantly updating these agreements, making sure that you're constantly on top of it. And what we'd usually suggest is when you're doing your annual business reviews, when you're doing your reviews with your financial advisor, when you're doing all of the regular checks and balances across your financial situation, this just forms another part of it, and policies are still relevant. We're not underinsured or overinsured. Yes, tick, the valuation methodologies are still the same. Yes, tick, everything is still the same, and you just move forward as opposed to just forgetting about it. This isn't one of the things that's just set and forget. It's certainly something that's a moving target and a moving beast, and you need to make sure that you're keeping it up to date.
The other consideration too is more so specifically with TPD cover, but using our example before of $1 million valuation, $500,000 of insurance each. In the event that a TPD claim is payable, there may be tax on that. So the $500,000 valuation may be right. The $500,000 insurance policy after tax is taken out could end up being less, which essentially would disadvantage the spouse or the family unit of the deceased business partner or the disabled business partner. In this instance, we take that tax consequence into consideration and potentially gross up the sum insured to be able to compensate and offset for the tax that would be payable. So the net proceeds of any payout would be the valuation of the business.
Exactly right. So really putting it all together and looking at the end state, look at what you want to achieve at the end of it, and then work out the correct strategy and the correct structure in order to achieve that.
The other thing that adds a little bit of complexity to this is, generally speaking, as we get older, we tend to get less and less healthy. So from an underwriting perspective, you may take out cover today while you're reasonably young and healthy, but then you go to increase down the track because the business value has increased. all of a sudden you've got health issues. Maybe you can't get cover. Maybe you get insurance loading, so it makes the cover more expensive. Obviously, the business partners are going to have different ages as well too, so the premium costs are going to be different. One of them may be a smoker, one of them may not. That impacts the premium as well too. So all of these little challenges need to be addressed within the business relationship and within the buy-sell contract as well too, about how all of those things are going to be treated. Because in the event we're using our hypothetical example before, where we needed to get cover because the business has increased, maybe I can do it, maybe Andrew can't because he's had a health issue or what have you. In that circumstance, what do? How does that then impact any future potential triggering of insurance policies, because it'd leave his spouse, his estate disadvantaged in that instance? So what do? How do we compensate for that? And that's just one of the challenges that we need to work through when we're putting these things together.
Yeah. And look, it's always going to be a bit of a challenge. There's always going to be a few moving parts to it. I think that the most important thing is making sure that you're having open communication, making sure that whether it's between business partners or spouses, that everyone's aware of, yes, this is how it's going to work. This is the end result. And this is how we're going to structure it in order to make sure that we get there. If you can't have adequate insurance, whether it's you equalize it from both parties, whether you have a funding mechanism in other means, as long as you're aware of, okay, there's going to be a shortfall of X amount of money, then the surviving business partner or the surviving spouse can at least account for it in some other way. But recognizing that up front as opposed to at a time of heightened emotion is incredibly important.
Yeah. And in summary, highly complicated, get advice.
Yep.
And specifically get advice, I'd say, with somebody who's qualified and who's a professional, somebody who's done this before, because it is easy to get it wrong. And you think about the competency of, say, a solicitor. There's been times where I've been involved in this process and straight off the bat, I could tell that the solicitor just did not have any idea. So I notified the clients and said, look, this is not going to work. This is the wrong person. They're going to make a mistake. It's going to be detrimental for you. Let's go in a different direction. Thankfully, they took that advice. So you need to make sure that if you are doing this, the person that you are working with has had experience with this before, because it's absolutely critical that you get it right.
Yeah, absolutely. No different to what we normally talk about. The need for making sure that you're getting good quality advice is very important. And hopefully this has brought something that most business partners haven't really considered. Hopefully it's brought it to the forefront. And if this is relevant to your situation, if you've got people that you're in business with and there isn't an agreement like this that's put in place, I'd strongly recommend that you either reach out to us or you reach out to one of your other trusted professionals and at least consider whether this is right for your situation. So feel free to reach out to either myself or Billy in the show notes. And thanks again, Billy, for another great podcast.
Andrew, thank you. And thanks to our listeners. And we'll catch you on the next one. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.